Let's turn now to Japan. J. Kyle Bass made $500 million shorting U.S. subprime mortgages back in 2007. Well, the head of Heyman Advisors said at a Bloomberg Link conference today that he has a more compelling bet. That is a quote. He says betting against Japanese government bonds is better than that subprime bet. Well, that negative sentiment towards the embattled country has been echoed in reports by all of the major rating agencies, including, of course, Moody's. And joining me now is Byrne. He's a senior vice president and regional credit officer for Asia and the Middle East for Moody's Sovereign Risk Group. Well, Byrne was a panelist at the Bloomberg Japan Link conference earlier today in Midtown Manhattan, and it's great to have you here in studio, yes. Tom. And, you know, Japan has fallen off the headlines, but that country is still very much struggling with the repercussions of the earthquake and tsunami.
Right.
All signs point to a much weaker economy, a much weaker recovery than previously anticipated. What will be the catalyst, though, for Moody's to downgrade?
Well, first of all, let me say that is one of our concerns there. Another area that we're looking at is whether the government will go ahead, as they intend to do, to unveil a long-term fiscal reform program. It could include some measures that would help reinvigorate the economy. Even though we have the rating under review for possible downgrade, we don't think a funding crisis, however, is imminent. The savings base is really large in Japan. Japan, unlike just about every other advanced country, does not rely on external savings. It does not borrow externally. Currency doesn't matter.
And now you've pointed this out in many of the things that you've written, that the country does, though, face a number of headwinds, not just from the earthquake and tsunami, the government infighting that's going on. We have a prime minister revolving door in that country. It's been 5 years since there's really been any stability in the government. How is that going to factor into coming up with a plan?
Well, I think it makes it more difficult. When the time this great catastrophe happened, the earthquake, some people were thinking, well, perhaps this would catalyze the government, the two parties, to act together, to act in unison, to address the country's challenges. Well, that hasn't happened. So we're in a position where we have a weakened prime minister, and yet the government is committed to unveiling a program that will affect the medium and long-term finances of the country.
What will that program look like for you not to have the country under review any longer?
Well, once we put a rating under review, we had it on negative outlook. The probability that we'd keep the current rating diminishes. Again, this is a matter of probability. What Japan did back in the Koizumi era, there was some doubt whether Koizumi would succeed, but what they did was they did reduce a budget deficit. They set their targets, they met them. It could have been a bit easier back then because there were expenditures to be cut. Cuts are usually the best and most effective way, empirically looking at what other countries have gone through when they had fiscal problems. Focus on cutting expenditures. Well, expenditures have been cut a lot already. Also back then, the global situation was much more buoyant. Japanese manufacturers are very competitive on the export sector, and if they're competitive, they're making profits, they're paying taxes to the government. Those conditions are different now. So that's another headwind that the government faces.
Now, that comment, that the quote that I was referencing from J. Kyle Bass earlier in the conference, I don't know if you actually saw that panel, but he's making that in reference to the fact that the government is sort of between a rock and a hard place. They have a tremendous amount of costs related to debt servicing, right? While the population is one that saves, the government has one that has used the debt markets really to finance its operations. If they raise interest rates, if interest rates do rise from here, that puts them in an even worse situation. So how do they spur economic growth while at the same time being able to afford their debt servicing costs?
Well, still, despite the financing needs of the government, the savings pool onshore in yen that's available for the government is still huge, and it exceeds the level of government debt. That situation will continue for some time. It's when perhaps Japan reaches that crossover point where the debt is so large it exceeds the stock of savings, household savings in the system, that you could reach an inflection point, a trigger point that would put in a risk premium to the government bond. What we've seen through the global financial crisis and through the March 11th disaster is that there's been no risk premium attached to the JGB. In fact, JGB yields have continued to tighten.
So if we look, though, at the credit default swap market, it is implying a further downgrade for Japan. So separate from what's happening sort of in the government bond market in Japan, there is the credit default swap market, which is pointing to a potential downgrade. And in J. Kyle Bass's points, he's saying potential insolvency.
Well, the last credit default swap measurements I looked at, it's still investment grade. It's Baa1. They fluctuate between A3 and Baa1 recently. The rating implied by bond yields is still AAA. So which market has a better signal? A smaller, less liquid credit default swap market, or this huge liquid JGB market?
All right, Tom, I appreciate you joining us today. Appreciate the insight.